Money didn't break in 2008. It hesitated. For a few quiet days in September, the most advanced financial system on Earth stopped trusting itself. Banks didn't know which banks were safe. Markets didn't know what assets were real. And governments realized something uncomfortable. The global economy wasn't powered by money. It was powered by belief. And that belief was cracking. What happened in 2008 wasn't just a financial crisis. It was a trust crisis. And the consequences are still with us. This matters now because the system that failed back then is still the system we're using today. Just larger, more complex, and more confident that it's fixed. So let's rewind. Before 2008, the world believed in a simple story. Home prices always go up. Banks know what they're doing. Risk can be engineered away. It felt rational. It felt mathematical. It felt safe.
In the United States, buying a house wasn't just a dream. It was an investment strategy. If prices kept rising, almost anyone could borrow, buy, and refinance later. So banks started lending to people who couldn't really afford the loans, not because banks were stupid, but because the system rewarded volume, not caution. These were called subprime mortgages, a polite name for risky bets. But here's where it gets interesting. Banks didn't plan to hold these risky loans. They sold them. Thousands of mortgages were bundled together into financial products called mortgage-backed securities. Think of it like this. You take a pile of IOUs from homeowners, wrap them into a box, and sell that box to investors. The box pays interest. Everyone's happy. Except there's a problem. Some of the IOUs are bad. So Wall Street did what Wall Street does best. It sliced the box. The top slice was labeled safe. The middle was moderate. The bottom was risky. Rating agencies stamped the top slices with AAA ratings, the same rating given to government bonds. On paper, it looked brilliant. Risk had been transformed. Danger had been diversified. Trust was manufactured. But the math had a hidden assumption that homeowners across the country would never fail at the same time. That assumption was wrong. When housing prices stopped rising, the system lost its balance. Refinancing dried up. Payments were missed. Defaults increased. One homeowner failing didn't matter. Thousands failing together did. The boxes started leaking, and suddenly no one knew what they were worth. Banks owned these securities. So did pension funds. So did insurance companies. They were everywhere. But because the assets were complex, no one could price them accurately. And when you can't price something, you don't trust it. Interbank lending froze. Not because banks were broke, but because they were scared. In September 2008, Lehman Brothers collapsed, a 158-year-old investment bank, gone in days. That wasn't just a bankruptcy, it was a signal. If Lehman could fail, anyone could. Money markets panicked, stock markets plunged, credit vanished. And here's the uncomfortable truth. The system didn't stop because it ran out of money. It stopped because it ran out of confidence. Governments stepped in with bailouts. Trillions of dollars were created almost overnight. And the public noticed something strange. When regular people failed, they lost their homes. When institutions failed, they were rescued. Losses were socialized. Gains had already been privatized. Trust didn't just crack, it shifted. People began to ask questions that had been unthinkable before. Is money real or just a promise? Are markets free or selectively protected? And who is the system actually built for? Officially, the crisis ended. Markets recovered. Banks survived. Regulations were written. But psychologically, something changed. Faith in expertise weakened. Faith in institutions declined. Suspicion became rational. That's not accidental. When a system claims to be precise, objective, and mathematical, and then collapses spectacularly, people don't forget. They remember that the experts didn't see it coming, or did and ignored it. They remember that ratings meant little, that complexity hid risk instead of eliminating it, that trust was borrowed, leveraged, and oversold. And here's the irony. To restore trust, central banks made money cheaper than ever. Interest rates fell near zero. Asset prices surged. The solution to a trust crisis was more faith in the same mechanisms. Today, debt levels are higher, financial products are more complex, markets move faster, and once again, confidence feels stable until it isn't. Because systems built on belief don't fail gradually, they fail suddenly. 2008 taught us that money is not just currency, it's expectation, it's credibility. It's a shared agreement that tomorrow will look enough like today. When that agreement breaks, numbers stop mattering. So here's the unresolved question. Did we fix the flaws that broke trust in 2008, or did we just learn to hide them better? Because the next time belief hesitates, it won't ask permission.